All right. Hi, Gabriel, Josiah here again. Okay, we'll be continuing our discourse on the financial statement analysis. The last class we looked at Unit 5, which had to do with types of financial statement analysis. All right, so we'll be looking at the next unit, which I'll be sharing my screen, and we'll be looking expressly into our discourse on financial statement analysis. Okay, so Unit 6, we'll be looking at techniques for financial analysis. What kind of techniques, how to perform financial statement analysis. So a number of techniques are normally employed in analyzing a business entity's financial statements. So you have these techniques when you are presented with financial statements on how to. Technique simply speaks to how to perform financial analysis. So these techniques employed in analyzing the business entity's financial statements include a comparative financial statement. So you're comparing particular period, years, vis-a-vis each of those years. Now, this comparative financial statement involves comparing an entity's financial statement over a period of time. Let's say 2-year period, 3-year period, 4-year period, or a 5-year period. So you're comparing each year to another year, just like we spoke about in the last unit on the horizontal analysis. So comparative financial statements analysis helps you to be able to understand what happened in the past. What are the antecedents, the trajectory the company went through in their historical data. This is very important. So one of the techniques is comparative financial statement analysis. It compares the entity's income statement, which is our statement of comprehensive income, traditionally based on the IFRS. We also look at the statement of financial position, which is our traditional balance sheet, over those same period of years. It provides meaningful information when compared to similar data of prior periods. So you have the income statement for, let's say, 2021, you have the income statement for 2022, you have the income statement for 2023, a 3-year financial statement or 3-year financial summary. So you're comparing those same statements, the income statement, the balance sheet, or the cash flow statement of the 3 years to see how was the performance of the company. So this technique helps you to be able to analyze and provide valuable conclusion or recommendation for your clients. So the comparison of the income statement enables a review of the operational performance of the entity over a period of time, so as to draw conclusions as to the direction of the entity's performance. So when you're comparing those 3 years I just analyzed, for example, you are reviewing the operational performance over that period. You're trying to ensure that what you've analyzed is predictable. It's predictable. When you see what somebody has done in the past, you are looking at his present, and you're able to predict the future as an analyst. This is very important. And also draw valuable conclusions as to the direction the entity is going. This is very critical. So a comparison of the statement of financial position during the period will reveal also the effects of operations on the assets and liabilities of the company. So assets are the company's, the entity's current assets are the company's or the entity's commercial value, while liabilities are the entity's obligations. So when the entity performs in 1 or 2 periods or accounting periods, it's necessary to be able to analyze these same periods from the SFP. The SFP will help you analyze what are the economic value in assets and what are the obligations in terms of liability to the entity. So you compare them in these different periods or years This will help you understand how the company has performed and what they own and what they owe. What they own are assets and what they owe are liabilities. This is very important to take note. This is carried out by determining the absolute and percentage changes in the composition of the income statement and the S&P within the periods chosen. So this technique helps you to determine the absolute and percentage changes. So what are the changes between those 3-year period in terms of percentage, and how have they performed? Is it good? Is it bad? Is it up? Is it down? And this will help you draw valuable conclusion within those periods. Now, the second one is common size statements. This analysis is done by converting the figures of the financial statements to percentages. Very important. So you're converting the figures of the financial statement into percentages. So, for example, we have an income statement. You convert the revenue as a percentage of other expenses, like we spoke about in the vertical analysis. For the income statement, the revenue figure is taken as 100%. The figures of other items of the income statement are expressed at the percentage of the revenue figure. So, for example, what's this percentage of cost of sales to your revenue, and what is the percentage of your gross profit to your revenue? This is a very good way to analyze and see how much chunk of the expense line is go up in the revenue. This is very important. Also, for the statement of financial position, the figure for the total asset is taken as 100%. So the total asset of the company, the non-current, which is the fixed asset, and the current asset, which is the working capital variant, is what we use as denominator. So as 100% your total assets, you check your liabilities, what are the percentage to those assets in the statement of financial position, and they are expressed as a percentage including your equity and other capital. Take note of that. The third technique is statement of changes in working capital or analysis of cash flow. The statement of changes in working capital provides information in relation to working capital between the financial periods. The amount of working capital for each period is determined by deducting the total current liabilities from your total current assets. This is clear. The explanation for this change is expressed by breaking the changes into the makeup of the total current assets. So you have a total current asset of your inventory, your receivables, your cash and short-term deposit, cash and cash equivalents. So you express them based on what you have with the current liabilities, which are your trade payables, your accruals, your short-term obligations, which are in the current liabilities. So current asset minus your current liabilities is expressed as your working capital. Now, the next technique is your trend analysis. Under this analysis, a particular year is chosen as the base, and 100% is assigned to all the figures in the financial statement for that year, especially the income statement. So you are observing a trend, you're trying to analyze the trend between each year, and you are taking a year as 100% to compare other years, and you assign figures in the financial statement, especially the income statement, to understand how the company has performed over this period of time. Trend analysis is very important in the case study exams, and also in practical life scenario in the office where we work. We need to understand this technique of financial analysis to draw valuable conclusions and provide advice to management and our clients on how the company has performed over time. Any percentage change in the relation to the base year is then calculated for all the other years in trend analysis. So generally, the first year of the financial statement provided is taken to be the base year. Then it serves as a base, and other years are the percentages to the base year. So trend analysis is used also to determine whether the financial health of the business entity is improving or deteriorating, and whether the results of the operation of its operation is improving or on a downward trend. So we want to see simply, is the company going up? Is it going down? Is it financially healthy or is it financially sick? This is very important. So the next technique, which is number 5, is ratio analysis, and this is common in general analysis, and it's very popular. This is the most popular way of carrying out financial analysis, and is widely used for analyzing financial statements. Financial ratios show the relationship between individual items or group of items of the entity's income statement or the statement of financial position. So you could pick a numerator from the income statement and a denominator from the statement of financial position, or pick a numerator from the statement of financial position and pick a denominator from the statement of comprehensive income. So the ratios work interchangeably. They work interchangeably. This is very important to take note. So ratios can be grouped either into 5 major headings. So we have profitability ratios, we have liquidity ratios, we have activity ratios, we have leverage ratios. So activity ratios are also known as efficiency ratios. We have leverage and shareholders or return ratios. So leverage or shareholders ratio, and we have return or investment ratio. So these 5 broad headings are generally ratios. These ratios are classified under these 5 broad headings. So I'll go over it again: profitability, liquidity, and activity or efficiency, leverage or shareholders, and return or investment. Take note of that. So ratios therefore highlight the key performance indicators of a business entity. It also reveals a lot about the changes in the financial conditions of a business. Very, very, very worthy of note. So the key performance indicators of the business can be brought to limelight from ratio computations. This is very important. Now, ratio analysis cannot be overflowed, and it helps you in the case study exams and also in practical business scenarios. So the ratio analysis and out of the 5 techniques we just discussed are very paramount in the case study exams and in your office. This is very important. Let me know what you think about these 5 techniques of financial statement analysis. So do that in the comment section. I'll check out what you have asked, what you've observed. If you have any question, I can address them. And please don't forget to share with other case study students or chartered accountants that may need this understanding, and also consider subscribing. Thank you very much for listening to this module. I said this unit, I beg your pardon, and I will see you in the next unit. Bye for now.